of risk in credit and equity index options, a role for option order flow. So the motivation for the paper is that there is, of course, already this very large literature on the relative pricing of debt and equity. So whether, say, the level of credit spreads or the returns on corporate bonds are consistent with data from the equity market. If we go to the option space, obviously for many years there's been options on equity, and especially equity indices are super liquid. For many years, there was not a similar product on the credit side, but since 2011, 2012, there is actually a very active market in options on credit indices. So the situation nowadays is that there are options on both credit and equity indices. So, of course, a natural question is whether these types of options are priced consistently. And there are already a couple of papers that look at this issue. So Pierre and I have a paper. There's a related paper by Doshi, Erickson et al. And the idea in the overall idea in both papers is to look at this issue through the lens of a structural credit risk model. So write down a structural model, write down the asset dynamics, price the indices, price the options on the indices, and try to determine whether these are priced consistently. And interestingly, the two papers reach somewhat different conclusions. So in my paper with Pierre, we found that these credit index options seem to be overpriced relative to equity index options, whereas this Doshi-Erickson paper finds that they cannot reject their structural model. In this paper, so I think it's fair to say that there's still some disagreement as to the relative pricing of these different types of index options. So we are taking another look at the issue in this paper, but we're doing it in a very different way. So first of all, we're going to not look at it through a structural model, but rather do a model-free empirical analysis. We're going to focus on returns and risk premia as opposed to pricing the derivatives through a model. And we're going to use much more data. So we're going to use both investment grade and high yield indices. And we're going to look both at the US and in Europe. And the main questions that we ask in the paper are whether the returns on these credit and equity index options are similar. And we find that that is very much not the case. The credit index options have average returns that are much more negative than equity index options. And that's a very robust finding across ratings and regions and across the entire volatility surface. Then we ask whether an equity-based factor model can price these credit index options, and we find that that is also not the case. In fact, there's a credit-specific factor that picks up most of the residual in the credit index options. And then finally, we ask whether the market structure and the order flow characteristics of these credit index options can explain part of this differential pricing of credit and equity options, and we find some evidence for that. So let me, maybe in the interest of time, skip the related literature. So this is the plan for the talk. So I'll first talk a little bit about these credit indices and their options and what the payoffs are. Then I will look at the returns on these credit and equity index options and compare them. Then I will introduce a factor pricing model for options and construct factor mimicking portfolios and compare the performance of the factor mimicking portfolios across credit and equity. And then I look at whether or how well this sort of an equity-based factor pricing model does in terms of pricing the credit index options. And then finally, I will link or try to explain this mispricing by relating it to the order flow in credit index options. So first of all, what is a credit index? So it's basically, so we're basically trading the index through what's called an index CDS. So it's like a regular CDS, but it's an a CDS that provides default protection on a portfolio of reference entities. So in North America, there's two main indices, CDX-IG, through which you can buy protection on 125 investment grade names, and the CDX-HY that provides default protection on 100 high yield names. And there are corresponding indices in Europe. And those are the four indices that we're going to look at in the paper. They all have a liquid options market attached to them. These index CDSs, they trade with maturities up to 10 years, with a 5-year point being by far the most liquid. And the way it works is that every 6 months, a new series of an index is launched. And when a new series is introduced, the set of index constituents is updated according to rating and liquidity criteria. And it's always the most recently issued series which is the most liquid. And actually, Pierre and I have another paper where we look at the liquidity of these indices and show that they're really super liquid. And so how are they priced? So they're highly standardized, so both in terms of payment dates and also in terms of the coupons. So the IG indices have a coupon of 100 basis points, the HY indices have a coupon of 500 basis points, but it also means that there's an upfront cost when you enter into the index CDS. And then the price quotation is, or they're quoted in terms of either spread or price. And in this paper, we use price quotation. And the price quotation is just 1 minus the upfront. And you can really think of the price as the price of a synthetic corporate bond index, where you buy a risk-free floating rate note and sell protection on the credit index, in both cases with a face value of 1 or a notional value of 1. And so you enter the index at a price of S. So say you do it at time t, at ST, and then you hold it for a delta period, and we're going to look at daily holding periods. So then what's the value at the end of the holding period? Well, if there's no default, it's trivial. If there is a default, then this is the value of the index at the end of the holding period. So each name in the index has a notional which is 1 over the number of names in the index. So here we just normalize the total notional to 1. So the notional is divided evenly across the index constituents. So if you bought the index, well, and you have a default, then it's 1 over n, so the notional attached to that name that defaulted times its recovery rate. And then the index continues. So then you have the price of the index without the defaulted name on a reduced notional. So then from this, we can construct a return on this synthetic corporate bond index. And then we have options on the index, and these are also highly standardized. The underlying is always the 5-year underrun index. So these are the most liquid index CDSs. They're European style. They always expire on the 3rd Wednesday of the month. They trade with a wide range of strikes with different maturities, but with the 1, 2, and 3 month options being the most liquid. And nowadays, liquidity is such that actually there's a credit VIX, which is constructed like a regular VIX, but is constructed using these credit index options. So what's the payoff of such a credit index option? Well, if we look at a call option, they're settled in upfront terms. So if it's a call option in upfront terms, and if you bought the index, if you bought the option at time t, and it expires at time capital T, well, then the payoff looks like this. So if you exercise the option, you will get the loss given default on the names that defaulted over the life of the option. So when you buy the option, there's NT names in the index. And then at option expiration, there's N capital T names. So the difference, that's the number of defaults in the index. And so you get 1 over n times the sum of the loss given default on the names that defaulted. And then you have a long position in the index without the defaulted names on a reduced notional. Right? So that's the payoff of a call option on the index. But now this is equivalent to a put option in price terms. So in other words, a put option on the corporate bond index and the synthetic corporate bond index that I talked about before. Right? So you can also express the payoff in price terms. So then the strike is 1 minus the strike in upfront terms. And then you have 1 over n times the sum of the recovery rates on the defaulted names. And then you have the value of the remaining index on a reduced notional. So those are the this is the credit index options that we're gonna look at. So in other words, we have options on the equity index and similar now options on a corporate bond or synthetic corporate bond index. And now the question is whether those are priced consistently. So this strategy in the paper, that is basically to compare returns on these credit and equity index options, matched on moneyness and matched on maturity. So the first thing you could ask is whether these returns are at all comparable, in the sense that suppose that we observe a large difference in the average return on credit and equity index options. Does that reflect mispricing or inconsistent pricing of the two sets of options? Well, not necessarily. So if we look at it through the lens of a structural credit risk model, where we write down the underlying asset process, and then from that we can price the indices and the options on the indices. Well, then the options, the credit and equity options, will have different exposures to the fundamental asset risk factors. And if these factor risk premia are different, well, then the options will also have different risk premia. So in general, we would expect these options to have different average returns. But now we show that if we look at delta hedged options, then they have actually very similar exposures. So we would expect them to have similar risk premiums. So if we observe large differences in the average returns on delta hedged options, well, then that is a strong indicator of these options not being priced consistently. So to show this, we go back to our previous paper and we take that structural model that we propose in that paper, in which we can basically price everything semi-analytically. And in that paper, the underlying asset process has a number of sources of risk. So there's diffusive risk, jump risk, and variance risk. And then we simulate daily returns on index options on equity and investment grade credit. These options have 2-month maturities. They're at the money. We look at puts and calls, and we look at both outright and delta hedged options, where the delta hedged options are with respect to the underlying index using the Black-Scholes model to compute the delta. So this is what we do in our empirical analysis. Of course, we do not observe the underlying asset process. We just observe the value of the underlying index. So we compute the delta with respect to that. And so in our model, we have these two systematic factors, so an asset factor and a factor driving the asset variance. And now in panel A here, I'm then showing the sensitivities, the Greeks, the delta, the gamma, and the vega with respect to the asset process. Right? So it's the delta and the gamma with respect to the A factor, and the vega with respect to the omega. And I do that for calls, for outright calls and puts, equity and credit. And if we compare the exposures, they're very different. They're very different across, so say within credit, they're very different for puts and calls. And they're also very different, say, within puts between credit and equity. And this is, again, what we would expect because we are in a structural model. There's no reason to expect these risk exposures to be the same. So for instance, just to give an example, if we look at the vega for the credit options, it's large and positive for puts. It's actually negative for calls. So this is a bit counterintuitive that a call option would have a negative variance exposure, but it's actually you can understand it because it's here we're pricing these options as compound options on the underlying asset value, because the indices themselves are options on the asset value, and the index options are then compound options. So if you write up put call parity for the index options, then we have call minus put equals index minus present value of strike. But the index itself is a function of the asset value and its variance. And so if variance increases, if we're looking at a credit index, the credit index is short a put option on the asset value. So a higher variance means lower index value. Then for the put option, well, higher variance, there's a direct positive effect from higher variance because index variance also increases. But then there's also an effect through the value of the index. When variance increases, the index drops in value. And so both of those contribute to a higher put price. And so the vega of the put is high. But for the call, you have these two opposing effects. So there's a direct positive effect here, but there's a negative effect from the fact that the index drops in value. And the net effect is actually that the call vega is negative. So in other words, the risk exposures for outright calls and puts are very different. So one should be very careful about comparing the returns on those. On the other hand, if we then look at the delta hedged options, so again, we're using Black-Scholes deltas with respect to the index, then the put call parity for the delta hedged options, so here the tilde means the delta hedged options, is simply like this. And so here the sensitivities are the same. The delta, gamma, and vega are the same for the put and the call. And that's exactly what we see here when we compare the delta hedge puts and calls within credit or within equity. But not only that, if we look across credit and equity, so for instance, delta hedged credit puts and equity puts, they have, well, not exactly the same exposures, but very similar exposures, right? The vegas are very similar here, whereas they're very different for the outright options. So this means it makes much more sense to compare the returns on the delta hedged options. We then also simulate the finite sample distributions of the average excess returns in samples that are similar to the ones that we will subsequently look at, around 10 years of daily data. And of course, the mean of these distributions are very different for the outright options because their factor exposures are very different. But for the delta hedged options, they're actually very similar. So if we look at delta hedged puts, the mean of the two finite sample distributions are very similar. And if we construct a long-short strategy, the mean is centered around 0. So not only that, also if we look at the width of the confidence interval of these finite sample distributions, then they're extremely wide for outright options. They're much more narrow for delta hedged options, and they're particularly narrow for the long-short strategy. So that means a long-short strategy, equity versus credit option, in delta hedged options is an excellent diagnostic for detecting mispricing between the two classes of options. So that's basically what we're going to look at subsequently.
So, but in that,
so what is the
statement, right? The maintained hypothesis is that the structural model is a reasonable description of the data.
Yeah, so here, of course, here we're just picking one structural model, and you could come up with other structural models. You could also vary the parameters. So of course, these finite sample distributions will depend on the model and on the parameters. But we will see when we look at the empirical performance of this long-short strategy that are highlighted here, the average return that we see in our sample is so far outside of this sort of finite sample distribution under the null that the structural model holds, that we think our conclusions are robust to using other structural models or varying the parameters. And so looking at the data, all the credit data, the indices, the options are from market. Equity index options are from SIBO and Eurex. So we're basically looking at options on the S&P 500 in the US and options on Eurostoxx 50 in Europe. And then on each observation date, we look at the 3 monthly expirations among the options that have more than 2 weeks to expiration. And we also look at 4 different degrees of moneyness. So where M here, that's sort of the standardized moneyness measure that basically measures the number of standard deviations that an option is in or out of the money. And so here we look at deep out of the money puts, moderately out of the money puts, at the money puts, and moderately out of the money calls. And so then from these options, we construct 7 equally weighted portfolios where we sort on moneyness and maturity. And the holding period is always daily. So we have daily returns on these portfolios. And the sample period is a bit more than 10 years from January 2013 to April 2023.
Clarifying question here. How is moneyness M measured? What's the definition of moneyness M?
So that is log moneyness over at the money implied vol times the square root of the option maturity. So I should probably have put it in the slides, but it's kind of, you can think of it as kind of based on the at the money implied volatility and on the log normal distribution, then the
number of standard deviations in or out of the money.
That the strike is away from the spot. Okay, so then here we simply report the Sharpe ratios on the 7 portfolios within each market. So we have options on investment grade credit, options on high yield credit, options on the equity index in the US and below in Europe. And so obviously the Sharpe ratios are for the most part negative. The striking thing here is that they are so much more negative on the credit side than on the equity side, right? And this holds true across different strikes, across different maturities. It holds true in IG and HY, holds true in the US and in Europe. So this is a very robust result. In addition to this, there's been some recent papers that argue that the profitability of selling equity index volatility has decreased over time. And we want to see if something similar is going on the credit side. So we also compute Sharpe ratios on an annual basis and then just average the Sharpe ratios over the 7 portfolios within each market. And then we get a picture like this. So these are year by year Sharpe ratios averaged across the 7 portfolios. So that does seem to be a tendency towards the profitability of selling equity index volatility having decreased also in our sample. On the credit side, though, it doesn't seem to be the case. If anything, in the second half of the sample, the average Sharpe ratios seem to be at least as large as they are in the first half of the sample. So it also seems to be a result that's very stable over time. And then we look at this long-short strategy where we go short an equity index option and long, short a credit index option and long an equity index option. And we do that for different degrees of moneyness. Here we trade equity versus IG options. Here we trade equity versus HY options. Again, this is the US market. This is the European market. We have another table in the paper where we do it for different option maturities. So here we just look across strikes. And so again, we find, maybe not surprisingly given the previous picture, that the Sharpe ratio in this long-short strategy is very large, typically above 1. And not only that, not only is the Sharpe ratio large, but also interesting, the skewness is positive. So typically when you sell volatility outright, well, or I mean through a delta hedged option, well, then you have kind of collecting nickels in front of the steamroller kind of strategy. So you have some big drawdowns, but here we're selling credit volatility, but we're at the same time buying equity volatility, and that seems to hedge these drawdowns. So in the end, we end up with a distribution that is positively skewed, but still has very large Sharpe ratios. So this strategy, I think, is particularly interesting because this is the strategy that we simulated. This is trading at the money equity puts against credit puts. And we saw in our simulation that the finite sample distribution for the average excess return is sort of centered roughly around 0 and has this confidence bound, this 95% confidence bound. What we observe in the data is this number, right? This is the annualized mean, and this is far outside of the 95% confidence interval under the null of the structural model. So I think this observation is very strong evidence against these options being priced consistently. It will be very, very difficult in the structural model to generate a return like this.
So let me ask a question about this, right? So a naive person like me thinks investment grade credit is about tail risk events. You're compensated for bearing the risk of tail events. But you show the structural model, you show that these different equity and credit index options have similar gamma and vega. But so those are local risk measures, right? So do the delta hedged equity index options and delta hedged credit index options have the same exposure to tail risk events?
They largely do, yes. So I think first of all, this is at the index level, and you have 125 names in the credit index. So a single default will have less of an impact at the index level, obviously, than at the single name level. And to a very large extent, these are short-term options. So you're really making a bet on not so much on the realized defaults. It's very rare to observe realized defaults during the life of the option. Is really a bet on one exposure to the mark-to-market, to the change in the mark-to-market value of the index. If that answers your question. So in any case, this is all priced consistently within the structural model, which of course allows for tail risk. Okay, so then we go one step further and we try to understand what are the underlying risk factors in sort of the context of a factor pricing model that drive the option returns. And so we sort of motivate a factor pricing model in the following way. So we consider an index, or we consider sort of this bivariate stochastic volatility model for an index. So S is the index price, and this can be equity or credit. And then there's some instantaneous volatility associated with that. Now, this instantaneous volatility is unobservable, so we're going to replace it with an observable proxy, which is the short-term at-the-money implied volatility. And so then we look at the option P&L by doing a second-order Taylor expansion. And so we express the change in the option price. So now we look at a particular option. We express that in terms of the return on the index and the relative change in this short-term at-the-money implied volatility. And so specifically, it's the return on the index scaled by volatility, and is the relative change in the volatility. But that's just because these numbers are more sort of comparable across credit and equity, and they're also more stable over time. So that's why we express it in those terms. But then we can compute the dollar excess return on a delta hedged options, and we show that there's basically 4 sources of risk that drive excess returns. So we have the realized volatility of returns, we have the change in implied volatility, we have minus the covariance between returns and implied volatility, which basically captures downside risk, and we have the realized volatility of implied volatility, so volatility of volatility, which captures overall tail risk. And the exposures, the option exposures, are then gamma, vega, vena, and volga. These are like standard Greeks in the option literature. And then the idea is so this is like a 4-factor model for option returns. And then we construct factor mimicking portfolios, so portfolios that are highly correlated with each of the risk factors. So tradable option strategies, where the first factor has large exposure to realized return volatility, second one has large exposure to the direction of implied volatility, and so on. So ideally, we want to construct factors, the first factor having positive gamma and 0 exposures otherwise, second factor having positive vega and 0 exposure otherwise, etc. Now, to do this, we need to be able to compute these Greeks for each option, and for that we're going to use the Black-Scholes model. So we're going to work with Black-Scholes Greeks, even if it's not sort of completely internally consistent, but it's robust, and it means that we get an easily implementable trading strategy. We could also work with a sort of a fully specified stochastic volatility model, where we can compute these risk exposures in an internally consistent way, but this would introduce some model dependency, would be much more complex. So we'd rather go for a robust, easily implementable strategy. So how do we construct these factor mimicking portfolios? Well, when it comes to gamma and vega, we're going to use straddles with different at-the-money straddles with different maturities. So if we have an at-the-money straddle, then the gamma is decreasing. So here I'm just plotting gamma as a function of option expiration, or time to expiration. So as time to expiry increases, the gamma decreases, the vega increases, and vena and volga is basically 0. And so that means that if we construct a strategy where we go long a short maturity straddle and short a long maturity straddle in a vega-weighted way, then we end up with a portfolio which has positive gamma, 0 vega by construction, and also effectively 0 vena and volga. Likewise, if we construct a strategy where we go long a long maturity straddle, short a short maturity straddle in a gamma-weighted way, then gamma will be 0 by construction, vega will be positive, and vena and volga will again be effectively 0. So these factors are constructed by trading at-the-money straddles with different maturities. Now, for the vena and volga strategies, we fix maturity and we look across strikes. And here I'm just plotting gamma, vega, vena, and volga across moneyness. And so the gamma and vega is well known. So vena takes this form, so it's negative for out-of-the-money puts, positive for out-of-the-money calls. And volga has this form, so it's positive for both out-of-the-money puts and calls. So if we construct a strategy, basically a risk reversal strategy, where we go long out-of-the-money put options, short out-of-the-money call options in a vega-weighted way, well, then we obtain a strategy that has negative vena It has 0 vega and also effectively 0 gamma and volga. If we construct essentially a butterfly strategy where we go long and out of the money put, long and out of the money call, and short and at the money straddle, then we obtain a strategy with positive volga. It's vega weighted, so vega is 0 by construction. Gamma and vana is also effectively 0. So these are going to be our factor mimicking portfolios. And then we basically do again the comparison between credit and equity, but now with the factor mimicking portfolios. And for each factor, there's actually 3 ways of generating the factor mimicking portfolio. So for instance, for vega, we can trade the 1 month versus 2 month option, the 1 versus 3, the 2 versus 3 month. So we implement all 3 and construct an equally weighted portfolio, and similar with the other factor mimicking portfolios. And so then here we just have the performance of these factor mimicking portfolios, gamma, vega, vana, and volga, and within each we have investment grade, high yield, and equity. And again, we have for the US market and for the European market. And for gamma, vega, and vana, the Sharpe ratio on the credit portfolios, the credit factors, are much more negative than they are for equity. So that holds true in the US market and in the European market. Maybe I should add that actually all of the factors, both in credit and equity, have negative mean returns. And this is what we would expect, because all these factors are factors that pay off, in other words, provide insurance against states that are probably perceived as being adverse, right? High realized volatility, high implied volatility, more downside risk, more overall tail risk. So it's reassuring to see that the mean returns are negative everywhere, but it's still when we compare across credit and equity, we see that the returns are much more negative on the credit side. And then we can construct a long-short strategy with the factor mimicking portfolios. And now if we do that, we see that the average excess return, especially on the gamma long-short strategy, so equity versus IG, equity versus HY, is positive. It's positive in the US market and in the European market. The Sharpe ratio are very high. We also get fairly high Sharpe ratio for the vega and the vana long-short strategies. Right? But it kind of suggests that this differential pricing between credit and equity options, to a large extent, comes through the differential pricing of the gamma factor. So now we have a factor pricing model for index options, and now the idea is to see whether that model constructed on the equity side, so from equity options, how well that performs for pricing credit options. But before doing that, we just want to verify that this 4-factor model performs well in SAM. So in other words, we take our option factor model for the IG market and see how well it does in terms of pricing IG options. And we do the same for HY and for equity. And so we have these 4 factors. And in fact, we also throw in the index return. This is, I mean, we're looking at the test assets are delta hedged options. So the loading on the index should be very small, but of course there could be a little bit of residual exposure. So we just, for completeness, we also include it. And so one way to compare to assess the fit is to say, what is the max Sharpe ratio that we can construct from the factors? What is the max Sharpe ratio that we can construct if we include options? So using both factors and options. And we see that the max Sharpe ratios are very close, which is indicative of good pricing performance. So we can formally test how close they are through the GRS test. I mean, it's sort of borderline whether you can reject the model. I think a more pragmatic way is to look at the alphas, the individual alphas, the t-stats, the r-squares. So we look at the average absolute alpha, the average absolute t-stat, the average r-square, and the alphas and the t-stats are very low, the r-squares are very high. So this is, I think, indicative of very good in-sample performance. So that holds true in each market. We have a model, and so for instance, now we take the equity-based model. It does very well in terms of pricing the equity index options. Now the question is, how well does it do in pricing the credit index options? And so we want to give this equity-based factor model the best possible chance to price the credit options. So we're going to work with both an unconditional model. We will also consider a model where we allow the betas to be a function of option Greeks, and one where we allow it to be a function of option Greeks and implied volatilities. As factors, we use both contemporaneous factors and lagged factors in order to take into account any non-synchronicity between credit and equity option returns. And we also separately use the equity factor model for the US market and for the European market. But however we do it, the equity-based factor model doesn't do a very good job. So for instance, the in-sample performance, if we look at the IG model, the average alpha was like 0.14. Now, using the equity-based factor model, the average alpha for IG is like 1.66. The average t-stats are very high. The average r-squares are very low. And this also holds true for HY, and allowing for sort of state-dependent betas. Also, I mean, it gives a small improvement, but not doesn't really change the picture. So the conclusion is that an equity-based factor model does a very poor job of pricing the credit index options. Then we run a PCA on the residual excess returns for the 14 credit options, right? So we have 7 IG options, 7 HY options. So in total, we have 14 credit option portfolios. So on the residuals, we run a PCA, and we find that a single principal component can explain 70% of the residual variation. In fact, in the European market, it's 75%. So there's a lot of common variation in the unexplained portion of excess return. So there seems to be like a credit-specific factor. So we construct this credit-specific factor. We call it the credit option residual factor as a portfolio of these credit option returns that are orthogonal to the equity index factors, and that credit option residual factor is in itself tradable and has a Sharpe ratio which is very large and negative. And then we add that, so we augment our factor model with that credit-specific factor. And then we see a very significant improvement when it comes to pricing the credit index options. So there's a large drop in the average absolute alphas, and then the average absolute t-stats, and a very large increase in the r-squares. So there seems to be a credit-specific factor that explains a lot of both the cross-sectional and time series variation in credit index option returns. Just as an illustration of the improvement in fit, so here we take the model, the factor pricing model, and plot the predicted excess return against the actual excess return. And of course, if the fit is perfect, we should lie on this 45-degree line. The blue crosses, that is for the pure equity-based model, and the red circles is when we augment that equity-based model with the credit-specific factor. So we see a very significant improvement in the fit. And so then the final question we want to investigate is, what is it that, or can we explain this sort of differential pricing of credit and equity index options? In other words, can we explain the variation in this credit-specific factor? And so in the industry, there's sort of this perception that there's a structural demand for credit index option coming from banks who use them to hedge what's called CVA risk. So there's a new capital charge that was introduced along with Basel III regulation. And so where banks, they have to hold capital against their CVA risk exposures. And the natural hedge for this CVA risk, and a way to reduce capital requirements, is to buy credit index options. So here's just a headline from a Risk Magazine article, which basically talks about that issue. So we wanted to check whether we could kind of confirm this in the data. So it turns out that banks, they have to disclose their CVA risk, or more specifically, the risk-weighted assets associated with CVA risk. They have to disclose that on a quarterly basis. So there are these quarterly regulatory filings. So we looked at those, and so then we constructed a quarterly time series for these risk-weighted assets associated with CVA risk for the large US banks. And so here I'm just showing the mean and the standard deviation for these risk-weighted assets. So this is in billions of US dollars. So these CVA risk exposures are large, and the capital that you have to hold against them are non-negligible. So the capital is typically 8% of the risk-weighted assets. Right? So they have a strong incentive to try to minimize those risk-weighted assets. And so not only are the risk-weighted assets large on average, but they're also quite volatile. And then we aggregated the risk-weighted assets across all the banks. And then we plot here the quarterly trading volume in credit index options against the quarterly change in the risk-weighted assets stemming from CVA risk. So in other words, so that's then over the quarter. So these numbers are reported end of quarter. So we take the change over the quarter and we relate that to the trading volume during the quarter. So in quarters where CVA risk is increasing, and so where the capital requirements are increasing, we also see higher volume of credit index options being traded. And so the coefficient is like 0.6. So it means that if risk-weighted assets increase by 1 billion, then trading volume increases by 0.6 billion. This is.
So I wanted to ask a question about this, but rather than do that, I will call your attention to the time, and I think it would be good if you could wrap up in about 5 minutes.
Yeah, that's fine. And so then, there seems to be that a lot of the volume is driven by shocks to hedging demand. So this is what we. So not only do shocks to hedging demand have an impact on volume, but we also think it has an impact on the pricing of these options. So we look at transaction data. We got all the transactions in credit index options. So these are publicly available through swap data repositories. It captures all trades where there's a US counterpart involved. So we have all the transactions. We have the size of the transactions. However, they're capped at 100 million. And in fact, most of the trades, especially in IG, are capped. So these are very large trades on average. So then from the transaction data, we construct daily order flow in terms of the number of trades, the number of cap trades, and the trading volume. And what we find is that this is a market which is characterized by relatively not that many trades per day, but each trade is very large. Most of the trades are capped. And so the total trading volume is actually fairly large. It's also very volatile. We have days where there's almost no trading, and then we have days with a lot of trading. So it is the case that in our data, or in our sample, the size of the trades are capped at 100 million. But in fact, more recently, this cap was raised to 400 million. So that occurred in October of last year. So that gives us more visibility into the size of these trades. But even after the cap was raised to 400 million, it's still the case that most IG trades are actually capped. We then have some additional information, so I won't have time to explain exactly how we do it, but we have some additional information from the CFTC that allows us to fit a power law for the cap trades. And so we get sort of a trade size distribution. We can infer a trade size distribution where we can kind of estimate what also the trade size distribution looks like for the cap trades. So this is the trade size distribution for IG options, and this is the one for HY options. And it turns out that we estimate that 7% of the IG option trades have a notional greater than 1.2 billion. 3% have a notional greater than 2 billion. So it's really the case that each trade, or at least some trades, are very, very large. So not only do we have this sort of one-sided order flow, which may affect prices, but we also have the fact that each trade is large, and dealers are taking on a lot of risk in each trade, and that probably also affects prices. So then we want to try to link our residual factor to this order flow, just to fix ideas. We have a sort of a parsimonious continuous time demand-based option pricing model in the paper. So basically the key elements is that we have a volatile order flow from end users, we have risk-averse liquidity providers, and we have stochastic volatility that generates some market incompleteness. And it's set in continuous time, but it's still highly tractable. This model is consistent with a negative unconditional excess returns on these credit options and on the residual factor that I've already documented. But we have 3 additional testable predictions regarding the relation between the residual factor and order flow. So the first one is that there's a positive contemporaneous relation between the excess return and order flow. This relation is stronger when dealers are more risk averse, and the expected excess return is more negative after high order flow. So basically we have end users, they're structurally buyers of options. Sometimes they buy more options. Dealers are then selling more. Volume is high. Dealers increase prices. So we have a contemporaneous increase in prices and therefore positive return. But then subsequently options are even more expensive. So the expected excess return going forward is more negative. So we test those predictions by regressing the residual factor onto the flow, the lag flow, and then we also interact the coefficient on the contemporaneous flow with this HKM intermediary capital ratio. And so the model predictions are that this coefficient, the beta 1, should be positive, the beta 3 should be negative, and the beta 2 should also be negative, so that when intermediaries are less capitalized, more risk averse, then the coefficient on flow is higher. And so we run different specifications of that regression, and both in the US and European market, we find support for these model predictions. So the So in fact, all the signs of the coefficients are consistent with the model predictions, especially the coefficients on the contemporaneous flow are statistically significant. So that concludes the presentation. So we show that we find consistently more negative Sharpe ratios on credit index options than equity index options. We find that an equity-based factor model cannot price the credit index options. And we show that the market structure and these sort of order flow characteristics of credit index options explain at least part of the difference in pricing between the two types of options. So any questions?
All right, yeah, thanks very much. There are some questions that I deferred given the time and because I thought they could wait to the end. So from Liang Wu, is it credit specific or contract specific or something else? As a thought experiment, suppose we do these factor returns on some single names, Apple, Nvidia, etc., and explain them with your equity index factor option returns. How high will be the R squared? You could also construct a similar residual return factor from the single names if it helps to explain the R squareds. It might make sense now for you to look at the chat and read this question. It's kind of a longish multi-part question.
Yeah.
Liang Wu, so it's not quite at the bottom, but
so I'm not a super user for
well, I'll let Liang restate his question and just see if he
Okay. It's an interesting paper. I like the results, and I have done some single name option returns in similar like return factor structures. So I believe your results are right. I just don't understand, or myself, like exactly where the source are, or the returns are, cannot be explained by equity index return factors. I actually find even single name options, their returns cannot be explained by the equity index return as well, or neither can be explained, right? So what do you call them? And if you do a PCA on the single names, it's like your residual factor stuff. It will also explain a big chunk of it. In addition to the equity index option return and the PCA of single name return are sort of different things. I just don't know what to call them, right? Here, I mean, since you're doing two markets, it's easy for you to just say, oh, that's credit, that's equity. But I feel like it's sort of more than that. It's not even necessarily driven by credit per se, but it's definitely driven by your order flow, whatever, by the market. Does it make sense? Or I'm just
yeah. I mean, it is simply a factor extracted from credit index option returns, right? So
yes, from that market.
It basically just captures
or the risk of that like variation of that market. Is that like I mean, English-wise, is that the same thing? Like credit risk, in my mind, is talking about really like issues driven by credit itself, right? Or suppose you are working in the credit market and the instruments get order flows, like what you find, some variations by themselves, right? Not necessarily driven by credit risk, but it is driven by something in that market.
Yeah, I mean, we're not saying that it's specifically credit risk related. I mean, it's related to credit index options, yes. Right? And so basically it's just a statistical factor that we extract, and then we want to subsequently try to understand where does this factor come from. And it seems natural for us to look at this flow explanation, but it's of course only part of the explanation. I guess one could think of other explanations also.
Thank you.
So let me ask a question, and there's a related question in the chat. So I understood from your discussion of CVA that the big derivatives dealers are likely to be natural buyers of credit index options? Who are the sellers? And then there's a related question in the chat, right? Is it possible to arbitrage this apparent mispricing? And then let me follow up that with what if I wanted to sell credit index options or delta hedge credit index options, how much collateral would I have to post?
Yeah. So first, who are the sellers? So I think the ultimate sellers, to a very large extent, are hedge funds, right? Some insurance companies. So Risk Magazine, they have like they sometimes publish a like top 5 of asset managers. So apparently there's some data where you can get positions of asset managers in these credit index options, and they are actually often big sellers of these options. So I think it's asset managers, insurance companies, it's hedge funds. It's basically a way to generate alpha. I think that answers your first question. Whether it's not really an arbitrage, but it is of course a very good deal, right? You can, as I said, if you do like this long short strategy, trading equity index options versus credit index options, you get very high Sharpe ratios, typically above 1. You have a return distribution that's positively skewed, and so that seems like a very good deal, but of course it's not a true arbitrage. And then I forgot what your third question was.
If I want to participate in this market as a seller, how much
Yeah.
collateral would I have to provide?
Yeah, that's a good question. I don't think it's. I mean, they of course they do trade OTC. I don't know. I would need to check.
Okay, are there other questions? I have some more questions, but I should give other people an opportunity to jump in.
I mean, just a simple observation. So it seems to be like this change where there was this requirement introduced via Dodd-Frank. If you have the data before and after, that would be like what corporate finance people call a natural experiment before and after.
Yeah. So actually, it's interesting that so we have this conjecture that a lot of the volume is due to this CVA hedging. The thing is that the market basically arose around the time that capital requirement came into effect. So it came into effect in 2012, which is also basically where these options started to trade a lot. So pre-crisis, there was very little trading in these credit index options. So back then it was more like synthetic CDOs. I think it's, at least it supports the idea that CVA risk hedging matters. That the start of the market more or less coincides with the start of this capital requirement. So it's really not possible to do this before and after, because there's no data on these prices before the capital requirement came into effect.
Okay, so let me ask one more question. So there's this other paper by Hitesh Doshi and Jan Eriksson and Matthew and Sang Seo, right? So
Yeah.
I think the message you take away from that paper is different from the message you take away from your paper. I think the message from that paper is that the equity index markets and credit index markets are priced consistently with each other. So why are you getting what seem like different results from them?
Yeah. So I think part of it has to do with how you calibrate your structural model. So again, they look at it through the lens of a structural credit risk model. I don't completely agree with how they do the calibration, but of course, I mean, different calibrations will give different results. I will maybe point to one thing. So one thing they argue in the paper, because they also look at some point towards the end of their paper on average excess returns on options. And then one thing that they argue is that, so let me see if I can find it. One thing that they argue is that they cannot reject their model based on average excess returns on credit and equity options, but they look at average excess returns on outright options. And what you can see here, and you can also infer that from their paper, the finite sample distributions for the average excess returns on outright options are extremely wide. Right, so there are more than 500 basis points when it comes to the annualized average excess return, and that means that it's just very, very difficult to reject the model. So such a test where you compare average excess returns in the data with the finite sample distribution implied by the model, well, it just has very, very low power. So maybe that's also part of the explanation.
All right. Any other questions?
Well, there are some questions about whether retail investors can make money here too. So,
Okay.
but of course, it's
looked at-
life is difficult for retail investors.
Oh yeah. Well, yeah. Is there any way for retail investors to short CDX volatility that you're aware of?
I don't think there's. I don't think there's. I mean, this is really an institutional market, and to my knowledge, there's no. There's also no like ETFs or whatever that kind of give exposure to these option strategies.
All right. If there are no other questions, then thank you everyone for coming. And in 2 weeks, we will change gears and Mike Chernov will tell us about the predictions contracts, which some don't consider derivatives, but we do. So see you in 2 weeks. And Anders, thank you for the great seminar.
Thank you. Have a good day.
Have a good evening.